But the challenge is there's just too much supply relative to demand. There's a couple main pools of buyers for treasuries. They could be the foreign sector, but they're not buying because the dollar index is strong. So they're in currency defense mode. They're not rapidly accumulating reserves. There's the Fed, but they're not buying. They're actually net selling by letting bonds mature off their balance sheet. There's banks, which were big buyers recently, but over the past year, that's reversed now. So banks are no longer buyers. And so that leaves only domestic non-bank entities. There's really only so much that can be absorbed.
Prominent macro analyst and investment strategist, Lyn Alden, has characterized the U.S. bond market as a state of disarray, a situation that may exacerbate in the forthcoming weeks and months. Recent reports highlight the concerning outcome of the Treasury Department's latest auction of 30-year bonds, indicating a potential shrink in demand for U.S. government debt. During the auction, bidders displayed their lowest interest in long-term 30-year Treasury bonds since December 2021. Primary dealers, comprising banks and financial institutions authorized to trade securities with the Federal Reserve, were compelled to acquire approximately 18.2% of the debt, exceeding the typical 11% share. Additionally, yields on these long-term bonds have been surging in an attempt to attract investors. The August high yield was recorded at 4.895%, reaching a high of 4.345% in September. In the most recent auction, the highest yield was noted at 4.837%, marking the highest level since 2007. According to a recent research note from Deutsche Bank, the lagging demand for U.S. bonds contributes to the upward pressure on Treasury yields. The 16 basis point increase observed on Thursday was the most significant daily leap since the market turmoil that unfolded in March 2020. This waning demand, despite high yields, presents a worrisome issue, particularly when the government is grappling with a substantial deficit and the necessity to issue more bonds. A report from the Congressional Budget Office highlighted that the federal budget deficit for the 2023 fiscal year stood at $1.7 trillion, marking a more than 20% increase from the previous year's $1.4 trillion deficit. The escalating U.S. debt situation has raised concerns, with the IMF describing it as worrying and deteriorating. Pierre-Olivier Gores, the director of the IMF's research department, emphasized the particularly worrisome nature of the U.S., where fiscal deficits have significantly worsened in 2023. He stressed the need for fiscal policy not to be pro-cyclical, especially in the current inflation cycle characterized by lower growth, higher interest rates, and reduced fiscal space. Appropriate structural reforms are deemed crucial during this stage. In a recent interview, Lyn Alden shares her insights on the U.S. bond market and provides her economic projections for 2024.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
We've seen a rebound in energy prices to a certain degree. We've seen a rebound in housing prices. So when you look at the Case-Shiller index, for example, house prices were correcting. Now they've kind of stabilized. They've gone back up in aggregate. And overall, I think that's kind of the trend we're in now, in the sense that we've had a permanent boost in terms of how much money's in the system. Even as the Fed tries to draw down their balance sheet, there's still money coming in from the reverse repo facility.
Right.
So it's kind of balanced at the current time. I think, around the margins, I kind of see us settling here for a period of time because there's still downward pressure on a number of industries from these rate hikes. But part of what's fueling the inflation is the very large fiscal deficits. And what makes this kind of different from other cycles, at least up to a point, is that most of the money supply growth did not come from the banking sector. It did not come from credit creation. It came from large fiscal deficits. And we have very high public debt levels now. And so the challenge is, the whole process of raising rates is meant to slow down bank lending. It's meant to slow down kind of the main driver of that money creation, which in the 70s worked because you had low public debt, you had very high demographic driven bank lending. But in this era and back in the 1940s, most of the money creation is from those fiscal deficits. And so the problem is when you raise rates, you actually increase deficits. We have over 100% debt to GDP. If you raise rates, that actually pours more money into the economy. And so I think they're kind of in this kind of balancing act here where it's going to be hard to fully land the plane. Anytime they mature and get reissued, it goes up. And so, if you run the numbers, we get up to something like 1.7 trillion on interest expense annually if you just hold rates where they are and have the full weighted average eventually catch up to that. Now, we wouldn't get that in the next couple quarters, but basically we continue to add tens or hundreds of billions of dollars in interest expense to the existing deficit at the current time. So I do think that we're going to continue to see very high bond issuance and continue to see extremely high and still rising interest expense, which is part of the deficit and is a source of money that is flowing out into the economy. I'd be a little bit hesitant to say push the shorts here. I mean, we already had a very large down move in bonds. I've been a bond bear for years. I mean, the speed of this move even was kind of surprising to me, even as a bond bear. Um, and so the real rates are starting to get interesting. I can see, for example, why someone would want to go long tips here. You get a
Hmm.
decent real yield on your position. The problem is not that at this point, I think they're appropriately priced. But the challenge is there's just too much supply relative to demand. Basically, the types of buyers that are not so there's a couple main pools of buyers for treasuries. They could be the foreign sector, but they're not buying because the dollar index is strong. So they're in currency defense mode. They're not rapidly accumulating reserves. Um, there's the Fed, but they're not buying. They're actually net selling by letting bonds mature off their balance sheet. There's banks, which were big buyers recently, but over the past year, that's reversed now. So banks are no longer buyers, and so that leaves only domestic non-bank entities. So insurance companies, asset managers, households. You and me. We're the kind of the only buyers left, and we're generally when we buy bonds, we don't buy them on leverage in the way that these like money creators can.
Hmm.
And so there's really only so much that can be absorbed. And so it's more of a mechanical issue than investors assessing them and saying that they're inappropriately priced. Um, and I think that's the challenge right now. And
Right.
so I do see ongoing problems that continue to occur. We could pause here. Bonds could get a little bit of a bid after such an oversold condition. But the risk reward is still relatively unattractive when you can hold T-bills, for example.
Yeah. Yeah.
And to the extent that I would get duration, I think tips are interesting, but the whole bond complex is it's still a mess.
During a conversation with Paul Barron, Alden delves into the risk markets, primarily focusing on assets like Bitcoin and their prospects in the coming months. While Alden is not particularly bearish on Bitcoin in the short term, she does not hold high hopes for a significant price surge within the next 3 to 6 months. According to the renowned macro analyst, the current global macroeconomic conditions, characterized by a rapid reduction in liquidity, will make a substantial price increase very challenging. However, Alden does not dismiss the possibility of Bitcoin seeing a rise of a few $1,000s at some point between now and the first quarter of 2024. There is one pivotal event that could swiftly shift Alden's stance from neutral to very bullish, as she details in her prediction and outlook for Bitcoin over the next 3 to 6 months.
Any sort of multi-month predictions challenging. There's all sorts of things that can happen, but in general, I view a lot of risk assets, including Bitcoin, as probably being kind of range bound during that time period. I don't see a lot of new liquidity coming to market, but I also don't see a high likelihood of major crashes. But I mean, if you get a liquidity problem in the bond market, that's where you could get a pretty severe drop in some of these risk
Right.
assets. When you look at Bitcoin price action historically, um, this won't tell you anything on a day-to-day basis, but on like a longer term basis, the major correlate it has is with global broad money in dollar-denominated terms. So if you look at global M2, what is the total value of it denominated in dollars? And is that, the rate of change, right? So what does the year-over-year figure of that look like? Bitcoin tends to be highly correlated with that. So basically,
Mm.
it's a way of saying that Bitcoin is correlated with monetary inflation, which is different than and precedes CPI inflation. And so during periods of rise in liquidity, either because central banks around the world are printing, or banks are making a lot of credit, or the dollar's weakening because that's the denominator for global M2 in dollar terms. When any of those major factors are kind of prevailing, Bitcoin is usually doing quite well. And when the majority of those factors are contracting and global M2 is flat or down, that tends to put negative pressure on Bitcoin. So at least that's the demand side. So the way I would
Yeah.
describe it is that over the course of this bear market, the supply side is tightened in the sense that fast money from the prior bull market has largely been washed out. A lot of coins have gravitated towards strong hands, people that are just dollar cost averaging in, hodlers. That's kind of a pattern we see in bear markets. And so there's like basically a coiled spring there. There's not a lot of liquidity for buyers that want to come in. I mean, there's just not a lot of coins kind of ready to leave hands. But then the question becomes, what sparks the next wave of demand? And I
Right.
think it will likely be the next rise in global M2. And I don't really see that as likely in, say, the next 1 quarter, 2 quarters. That doesn't mean you can't fluctuate. I mean, you could go anywhere but up over 30,000. You could go retest 20,000. I don't really have a firm view on that level of range, but I think until it would probably to see a bigger move, we'd have to see a pretty significant move in global M2. Other than maybe a spot ETF or something, that might be the other
Sure.
catalyst. It's just a wild card that we don't know if that's going to happen in the next 6 months or not. I think that there probably would at least be a short-term pump. Whether or not that would have staying power, I think that's a good question. I don't think you'd see necessarily massive inflows right away, but the market, market participants would have to then adjust what the next bull
Right.
market's going to look like if a spot ETF exists versus one that does not exist, right? So Bitcoin is not just buyers and sellers right now. It's also people looking out into the future and saying, what is the probability that this thing is going to be successful, right? So what does the regulatory clarity look like? Where are the sources of buyers going to come from? So overall, that is a new variable on forward expectations of price, which is for most participants would be pretty constructive. So I think that could give you either a quick bump or maybe a more durable kind of smaller, higher level to kind of stagnate around for a while. But I think where that becomes relevant, particularly, is if we have a spot Bitcoin ETF and then we get that global M2 rise, because then the spot ETF's there to absorb any liquidity that wants to come into it that doesn't want to go on chain, right? So there's plenty of capital in brokerages, in 401ks, in other types of environments that would probably make use of a vehicle like that. They've had kind of very limited vehicles so far. So I think it's a catalyst, and that can certainly move around price either to the upside or downside based on what news we get. But I think the more durable rise is likely to happen with the aforementioned global broad money supply.
Meanwhile, Jamie Coates, a Bloomberg crypto market analyst, has delved into the future steps of the United States government and how Bitcoin stands to significantly benefit. In a recent post, Coates emphasized the inevitability of the return to currency debasement by the U.S. government and how Bitcoin will emerge as a primary beneficiary of a Federal Reserve policy reversal. Coates' post highlights that allocating just 1% of a traditional 60-40 portfolio to Bitcoin between 2015 and 2022 would have yielded significantly higher returns compared to solely sticking with equities and bonds. To illustrate the potential impact of reallocating 1% from bonds to Bitcoin in a 60-40 portfolio, Coates provides a chart revealing a total return of 76.77% for the portfolio with a Bitcoin allocation, as opposed to 66.1% for the traditional 60-40 portfolio. However, Coates acknowledges that while the 1% Bitcoin allocation would represent an improvement, it still wouldn't have kept pace with the level of monetary debasement over the same period, underperforming by 4%. Coates further notes that as more investors take into account the concept of currency debasement and add Bitcoin to their portfolios, bonds are poised to be the major losers. This scenario may be on the horizon, especially if the Federal Reserve is compelled to return to quantitative easing, as Coates anticipates. Coates emphasizes that, for investors not constrained by fiduciary obligations, position sizing should consider the monetary debasement factor, as nominal returns prove to be an ineffective measure in the current fiat central bank framework. Based on the financial situation of the U.S. government, debasement appears to be the only viable option, which is detrimental to bonds but favorable for hard assets. Feel free to share your thoughts on Lyn Alden's and Coates' outlooks for Bitcoin, bonds, and the overall U.S. economy in the comments section below. For more Daily Dose Crypto news, check out these two awesome videos on your screen. Click now and we will see you on the next video.